First up, let's talk about volatility. Now, when we say volatile, we're not talking about your Uncle Gary after a few pints of Guinness. We're talking about price swings so dramatic, they make a roller coaster look like a relaxing Ferris wheel ride. 1 minute your investment is soaring higher than Elon Musk's ego after a successful rocket launch. The next, it's plummeting faster than a lead balloon filled with bad financial advice. Remember Bitcoin's wild ride in 2021? Peaked at nearly $69,000, then crashed down to under $20,000 just 6 months later. That's a 70% drop, folks, enough to turn even the most hardened investor's hair a little grayer. So, how do you survive this financial earthquake? Well, the golden rule is simple. Never invest more than you can afford to lose. Seriously, treat it like that questionable shrimp dish at the all-you-can-eat buffet approach with caution and be prepared for the consequences. Then there's dollar cost averaging, or DCA for the cool kids. It's like a slow and steady tortoise, gradually building up your investment over time, instead of going all in like a hair-brained gambler. And finally, diversify. Don't put all your eggs in one digital basket. Spread your risk across different assets, because even if one crashes and burns, the others might just keep you afloat. Cryptocurrency may exist in the digital realm, but that doesn't make it immune to good old-fashioned theft. Imagine a bank where the vault is just a line of code, and the security guards are all on a permanent tea break. That's the reality of cryptocurrency security. Hackers, scammers, and all sorts of digital ne'er-do-wells are constantly trying to break in and make off with your hard-earned digital loot. Remember Mt. Gox? Back in 2014, this major Bitcoin exchange got hacked, and poof, 850,000 Bitcoins, worth hundreds of millions of dollars, vanished into thin air. So, how do you protect your precious crypto from these digital bandits? First, invest in a hardware wallet. Think of it like a high-tech, offline Fort Knox for your digital assets. Next, enable two-factor authentication on everything, and we mean everything. It's like having a bodyguard for your accounts, even if that bodyguard is just a series of annoying security questions. And finally, be wary of phishing scams, those digital sirens luring unsuspecting investors onto fake websites with promises of easy riches. Always double-check those URLs, folks, because in the world of crypto, one wrong click can cost you a fortune. The world of cryptocurrency regulation is like the Wild West, lawless, unpredictable, and full of surprises. 1 minute, governments are scratching their heads, trying to figure out what cryptocurrency even is. The next, they're slapping down regulations faster than a saloon brawl. Take China, for example. In 2021, they decided to ban cryptocurrency trading and mining altogether, sending shockwaves through the market and causing a collective panic among investors. Talk about a regulatory roller coaster. So how do you navigate this ever-shifting landscape? Well, knowledge is power. Stay informed about the latest cryptocurrency regulations in your country, because what's legal today might be banned tomorrow. Be cautious of investing in cryptocurrencies that might be targeted by regulators, like those shady privacy coins that make governments nervous. And if you're feeling extra cautious, consider allocating a portion of your investment to regulated crypto-related products, like ETFs or funds. They might not offer the same Wild West excitement, but hey, at least you'll sleep better at night. Scams and fraud. Don't be a crypto cowboy's next victim. The anonymity and decentralized nature of cryptocurrency make it a scammer's paradise, a digital playground where they can prey on the unsuspecting and disappear with their loot faster than you can say rug pull. Remember the Squid Game token scam? Investors, blinded by the hype of the hit Netflix show, poured millions into this token, only to watch in horror as the price plummeted to zero. Turns out the creators had pulled the rug out from under them, disappearing with the cash and leaving investors with nothing but a virtual slap in the face. So how do you avoid becoming the next victim in a crypto con? First and foremost, research. Don't just blindly follow the hype or the latest meme coin craze. Dig deep, understand the project, the team behind it, and the technology involved. If something sounds too good to be true, it probably is. And finally, stick to reputable platforms with a proven track record. Yes, they might charge fees, but consider it an insurance policy against getting scammed. Lack of consumer protections. Crypto's Wild West justice system. Welcome to the Wild West of crypto, where transactions are irreversible, and consumer protections are about as common as a sober cowboy in a saloon. Unlike traditional banking, where you've got institutions, regulations, and probably a very nice customer service representative named Brenda to help you out. In the crypto world, you're pretty much on your own. Remember the FTX collapse in 2022? One minute it was the darling of the crypto exchange world. The next, it was filing for bankruptcy, leaving countless users locked out of their accounts and wondering where all their money went. So how do you protect yourself in this lawless digital frontier? First, treat cryptocurrency exchanges like you would a public restroom. Get in, do your business, and get out. Don't leave large sums of money sitting on exchanges for extended periods. Instead, store your long-term holdings in a private wallet where you control the keys. Second, choose your exchanges wisely. Look for platforms with insurance funds or recovery mechanisms, just in case things go south. And finally, always double, triple check those transaction details before hitting the send button. Because once that crypto is gone, it's gone for good. Technological risks. Navigating the minefield of blockchain bugs. Cryptocurrency may seem like magic internet money, but behind the scenes, it's all built on complex technology. And complex technology, as we all know, is prone to glitches, bugs, and the occasional catastrophic meltdown. Remember the DAO hack back in 2016? A flaw in a smart contract, the very code that governs these decentralized applications, allowed hackers to drain millions of dollars worth of Ether. It was the digital equivalent of leaving the back door to your bank vault wide open, except instead of robbers, it was a bunch of ones and zeros making off with the loot. So, how do you navigate this minefield of technological risks? First, stick to well-established cryptocurrencies with strong development teams constantly working to patch up vulnerabilities and keep your digital assets safe. Think of it like choosing a car. You wouldn't buy a used clunker with a history of engine trouble, would you? Second, stay informed about blockchain upgrades and how they might affect your holdings. These upgrades are like software updates for your crypto, and sometimes they can introduce new risks or change the way things work. And finally, always test the waters before diving in head first. Send small transactions first to make sure everything is working as it should before moving large sums of your hard-earned crypto. Environmental concerns. The carbon footprint of your crypto. Now let's talk about the elephant in the digital room. The environmental impact of cryptocurrency, specifically those energy-guzzling proof-of-work cryptocurrencies like Bitcoin that require vast amounts of electricity to mine. We're talking about enough energy to power entire countries, folks, and it's not exactly coming from renewable sources. It's like trying to save the planet by driving a Hummer powered by coal. Well-intentioned maybe, but ultimately counterproductive. So, what can you do if you're concerned about the environmental impact of your crypto investments? First, consider supporting cryptocurrencies that use more eco-friendly consensus mechanisms, like proof of stake, which requires significantly less energy to operate. Think of it like choosing a fuel-efficient car over a gas guzzler. You're still getting where you need to go, but with a much smaller carbon footprint. Second, stay informed about the latest developments in sustainable mining practices and support projects that are actively working to reduce their environmental impact. And finally, remember that every little bit helps. Even choosing to invest in a more sustainable cryptocurrency can make a difference in the fight against climate change.